Good morning and welcome to Red Cloud's 2021 Oktoberfest Fall Mining Showcase. My name is Alina Islam and I'm a research associate here at Red Cloud Securities. Next, we are pleased to host Anfield Energy and have with us Corey Diaz, CEO of the company. Corey, you will have 10 to 12 minutes for your presentation and a few minutes at the end for a Q&A session. Attendees, please feel free to ask your questions using the Q&A link. And with that, Corey, I'll hand it over to you to present the Anfield story.
Great. Thank you, Elena. And welcome participants in the conference. Thank you for taking the time to chat with me with regard to Anfield Energy. Anfield Energy is a US-based development and near production story. We have a large portfolio of 25 ISR properties in Wyoming, of which the Charlie ISR project is our flagship project. It has about 4 million pounds of resource available to us. It sits adjacent to Uranium One's Willow Creek production operations and in between two of Uranium One's existing mines. We have an agreement in place with Uranium One to produce up to 500,000 pounds per year at its existing facility. We did complete a PEA for Charlie back in 2019. Which provided robust economics. So there's a very low cost near-term opportunity through Charlie in Wyoming for the company. On the other side of the business, we hold hard rock assets, including the Shooting Canyon Mill, which is one of only 3 licensed, permitted, and constructed mills in the United States. We do have a significant amount of resource that could potentially be put through the mill to create another long-term viable production opportunity on the hard rock side of our business. So, overall, we think that we're an interesting company because of our access to existing processing facility and infrastructure, low permitting risk, low capital costs, long-term optionality between ISR and hard rock. We think that the opportunity will continue to evolve as we see the price moving up. So our strategy is twofold. So first of all, we're trying to create a company that has 2 paths to production, one in the low cost environment, which is ISR, and one in a higher cost environment, assuming the uranium price continues to move up into that $60 to $80 range, where we could potentially turn on the mill and fill the mill with the material that we hold in Colorado and Utah. But we do think that ISR is the place to be at the moment, given the low cost opportunities that sit in Wyoming, both with Charlie and the 24 other projects that we hold in Wyoming, where we can create a pipeline. And then certainly as the market price improves, we look to leverage our hard rock assets, including the mill, to create a longer term viable, sustainable production opportunity. So here's a view of our capital markets profile. We're sitting at about 304 million shares, market cap of just over $45 million today. Management insiders hold about 6% of the shares. Cotter Corporation is our largest institutional shareholder at the moment, 4%. And we do have research coverage out of Red Cloud. Management directors, we do have a fair amount of uranium experience on our board, including not only general experience, but also asset-specific experience. For example, Scott Lumadue has worked at Converdyne, which is a conversion facility, Duke Energy, which is a utility, Uranium One, which is a producer, and New Mexico, which is a trading company. Josh Bleak, it comes from a mining family. He's our man on the ground in the US, has worked in uranium for a number of years along with generations of his family, and so is very familiar with the landscape in the US. Don Falconer has worked at both publicly traded companies and for utilities in the Canadian market and sales and marketing, determining the pricing of contracts between utilities and producers. Stephen Lunsford is 40 years in Wyoming, so is very familiar with the landscape and has asset-specific experience related to the Charlie project. So we do have a really good mix of management and board. So in terms of the catalyst for the market, we've already talked about in the past the Uranium Reserve Program, which gives opportunities to those companies which have near-term production opportunities or paths. That includes Anfield. There is a new Infrastructure Investment and Jobs Act that's expected to be signed in the coming months with the Biden administration, which underpins the government's commitment to nuclear, which is obviously positive for the company. Obviously, the recent comments out of Japan related to nuclear being indispensable to decarbonizing Japan, and Japan aiming to be carbon neutral by 2050. That's obviously another positive. A lot of the material that's been sitting, a lot of the uranium material that's been sitting in the Japanese market is likely to be used within the country. So that means that there'll be fewer bits of material to come out into the open market for sale, suppressing the uranium price in the future. Finally, in North America, we talk about the Sprott Uranium Fund, which has been buying up a number of the assets that are sitting in the spot market, the uranium material. We've seen the recent announcement from Kazatomprom looking to buy material in the spot market once again. So the spot market's not a place where the U.S. utilities can turn in order to buy more material and avoid signing contracts. So I think all of these things are leading to a higher price in the spot market, but also putting the utilities in the position to have to go back to the table in order to sign longer term contracts, because the spot market material that they've been looking to buy is no longer going to be available to them, and certainly not at the low prices as before. So our steps to uranium production, we've got a couple of steps that we've been considering. First of all, Charlie, the project that I mentioned earlier, there's about a $6.7 million pre-production cost. The aim here is to use this project as our initial move into production, while we leverage our resin capture and processing agreement that was signed with Uranium One to use its existing production facilities in Wyoming. And we can produce up to 500,000 pounds per year at the facility. So Charlie would be the first feed through this new contract. This is our focus because it's clearly going to fit into the upcoming uranium cycle. In the future, we have another 24 projects in Wyoming. Our aim is to take the most viable 5 or 6 of those projects to create a pipeline of 10 to 50 million pounds, which would serve as the follow-on feed once Charlie is depleted. Once again, we'd be leveraging the same resin capture and processing agreement we have with Uranium One in order to produce from these assets. So some of these assets we believe will fall into the current cycle, and some may fall outside depending on how much work is required to bring them up to pre-production status. And then finally, the blue sky opportunity that we have in our portfolio relates to the conventional assets that we hold. So we have a conventional uranium mill, which is called Sheetering Canyon. This mill can produce up to 1 million pounds per year of uranium. Obviously, it requires a much higher price than the ISR projects, probably in that $60 to $80 range, in order for us to move forward on this asset. The cost to refurbish the mill could be anywhere between $30 and $40 million. The cost to build a new mill is roughly $200 million. So we think that it's much more viable to refurbish a mill than to build a new mill. Assuming you can build a new mill, you don't have any issues with finding land or the time to build a new mill. So from our perspective, we think that this is a huge opportunity for us. We've acquired not only properties in Utah next to the mill, or relatively close to the mill. We have about 7 million pounds there, but we've also acquired properties in Colorado, which hold roughly 11 million pounds of uranium and 53 million pounds of vanadium, which could serve as follow-on feed for the mill. So we can create another pipeline there of long-term sustainable production on the hard rock side of our business. So here's a map showing where our assets lie. As I mentioned, we have both ISR and hard rock assets. The assets in the gray are our ISR properties in Wyoming. I'll give you a sample. And then the blue dots to the south are our hard rock assets, including the mill. So you can see that we've got a good mix of projects within a relatively close area of the market. So as I mentioned, the Charlie project, we acquired this in 2019 from Cotter Corporation. Production timeline of about 24 months based on the proximity to Uranium One's producing mines and its processing facilities. We do have the agreement for £500,000 per year in terms of production capacity available to us. And we believe there's another 400 to 800,000 pounds available to us through an exploration target should we look to expand this asset. The PEA had a pre-tax NPV of about $18.9 million, pre-production capex of $6.7 million, so relatively low cost, direct OPEX of $23 a pound, and all-in cost of about $36 a pound. So even in the current environment, this could be a viable, profitable project. So here's a map of our remaining 24 Wyoming ISR projects. You can see that the cluster to the northeast, those are in relative close proximity to Charlie and to the processing facilities held by Uranium One. We have some to the southwest. Those assets are relatively close to Ura Energy. So there's the potential to JV or sell or do some kind of transaction with Ura Energy going forward if that's the path we choose to take. And you can see down to the bottom left of the page, we show the resource estimates for the projects that we've done economics on ourselves. So Blue Sky, Velvet Wood, this is our flagship hard rock asset. This would be first feed into the mill once we have it up and running. We do have a PA for this project, about $63 million, producing just over 660,000 pounds per year. Certainly, this is a project that we believe would be a significant boon to the mill once we have it up and running. The other assets that we have on the hard rock side of the business, including the mill, the Frank-N deposit, which is right next to the mill, the West Slope project that I mentioned in Colorado, 11 million pounds of uranium and 53 million pounds of vanadium. We have some assets in Arizona, Brescia pipes, and then we have a portfolio of royalties, including on the projects of 3 publicly traded companies. But you can see that the mill is surrounded by a number of other hard rock assets, not only our own, but others held by Encore Energy and Western Uranium, for example. And here's our peer comparison. You can see that on a market cap to resource basis, we traded a significant discount to our peers. Even at the average, we'd be looking at a much higher price, probably 4 times where we sit today. We certainly think this is partly because we're not as well known as our peers, but we also believe that as we work with Uranium One to remove any kind of debt overhang related to the story, we think we'd be moving closer to the average. And I think that's something that we'll be addressing in the coming months. But certainly we do think that the potential upside to our story is much stronger than our peers. And certainly we do think that a rising tide will lift all ships. And so we do think that we'll get greater value going forward when it comes to valuation in the uranium space. So ultimately, Anfield has 2 paths to production. We've got the lower cost, smaller scale, and near-term production through ISR and specifically Charlie. We do believe that on the hard rock side of the business, that'll be driven by the continued increase and uptick in the uranium price. And we do think that we can start leveraging our own production opportunity and hard rock as the price continues to soar. We do think the supply-demand imbalance is much more stark than it was back in 2006 when the uranium price shot to $137. So we do think that we're well positioned to gain significantly as the price continues to move up, and companies like Sprott and Kazatomprom continue to remove material from the spot market and bring the utilities back to the table. So we also have assets outside of our uranium portfolio, which include a gold asset, Newsboy, which I didn't address, but certainly this is something that we look to continue to incubate and sell assets in order to derive even greater value for our holders going forward. But we certainly do think that our focus is uranium and specifically ISR in the near term. But we do think that there are greater opportunities for us going forward, especially as the market continues to correct.
All right, Corey, thanks for a great presentation. We have about 30 seconds left. So very quickly, can you just highlight maybe what investors can expect from a news flow perspective in the next, say, 6 to 12 months?
Sure. I think there are a couple of things that we'll be looking to do. Obviously, some of it will be price dependent, but certainly we'll be looking to address the debt that we have with Rosatom, which is the parent of Uranium One. We think that we've reached a point where a settlement is possible with the Russian-owned entity. So that's one bit of news that we expect to see kind of going forward. I think the second piece would be related to Charlie as we advance that asset even closer to production. Obviously, that's once again price dependent, but given where the price has been moving, we're certainly confident that moving that asset forward in the near term is something that we have a huge desire to do. Thirdly, we'll be looking at being opportunistic in the market, potentially acquiring other assets which complement our portfolio as it is, as we look to create that pipeline of assets both in Wyoming and in Utah and Colorado. So we do think there'll be lots of activity taking place. Certainly the market, I think, it lends itself to opportunities and being opportunistic and looking to do some transactions.
Well, that's great, Corey. We're over time now, but thank you so much for the presentation, and thanks everyone for joining us. Up next, we have UEX Corp.
Thank you, everyone.